Today I'm going to talk about generally accepted accounting principles. Every business firm keeps records of business transactions, and these records are used at the end of each year to find out profit or loss or financial position of the business. Now, in order to maintain the records of business transactions and to prepare various accounts, a business firm has to follow certain rules, principles, guidelines. And these rules, principles, and guidelines should be the same so that there is uniformity and consistency maintained. These rules, principles, and guidelines are adopted by accountants all over the world for recording and maintaining business transactions and reporting it to various people. This rule, that is GAAP, generally accepted accounting principle, brings uniformity and consistency. That means a person from any part of the world will be able to understand, read the accounts prepared by another part of the world. Now let's see what are these different principles. Number one is business entity concept. Now this concept states that a business firm and the owner who has started the business are two different people, two different individuals. A business firm is considered as one individual and its owner is considered as another individual. So there is a separation between the two. The business transactions are separated from the owner's personal transactions. That is the reason why when the owner brings some amount of money into the business as capital, his capital is recorded as a liability in the business book. In the same way, when the owner takes away something from the business like goods or money for his personal use, then this is recorded as his drawings. Next is money measurement concept. This concept is very important because it helps an accountant to find out what to record and what not to record. It states that only those transactions which can be expressed in terms of money can only be recorded in the books of accounts. If business activities cannot be quantified in monetary value, then that activity should not be recorded in the books of accounts. That is the reason why the honesty of an employee, the hard working of an employee, the effort put in by the employees, these cannot be quantified in terms of money, so these are not recorded in the books of accounts. Third one is going concern concept. Now this concept states that a business organization carries on business for a long period of time. That means the life of the business is undefined. The firm will do business for an indefinite period of time. That is the reason why the assets of the business are divided into fixed assets and current assets. Likewise, the liabilities are categorized into long-term liability and short-term liabilities. Next, you have accounting period concept. This is very important because every business owner wants to know the result of his business activity, whether the firm has earned profit or suffered loss, and he cannot wait for a long period of time. So the life of the business is divided into small parts, each of 1 year duration. So the accounting is kept for a duration of 1 year, that is 12 months. And financial statements are also prepared for that duration of 1 year. And this duration of 1 year is known as accounting period. and this accounting period in India starts from 1st April to 31st March of next year. The next concept is dual aspect concept, which is also known as double entry principle. This principle states that every business transaction has two effects. Two accounts are affected in every business transaction. That means you will have debit aspects and credit aspects. And the value of debit aspects is always equal to the value of credit aspects. And both these aspects are recorded in the books of accounts, once on the debit side and again on the credit side of another accounts. Another one is matching concept principle. Matching, that means you have to match two things. What are the two things to be matched here? The revenues and the expenses. This revenue and expenses are considered in order to find out the profit or loss of the firm, and profit and loss is calculated for 1 year. That is why the expenses and revenue of that particular period should be matched in order to calculate the profit or loss. That means the expenses which are used in generating revenue should be considered in calculating the profit or loss. If you are calculating the profit or loss for the year 2020, then you have to take the expenses of 2020 and also the revenues of 2020. It means the revenue and expenses incurred to earn the revenue must belong to same accounting period, so that the true profit or loss of that particular period can be calculated.